Hey everyone, this is the Halifax Real Estate Podcast. My name is Jason Paul and I'm a licensed realtor at Keller Select Realty in Halifax, Nova Scotia. I'm here to help you gain a better understanding of real estate in Halifax and introduce you to a wide variety of people that work in or with our industry as well. With over 30 years of commercial real estate brokerage experience in the Halifax marketplace, Tom Gerard has successfully completed over $500 million of investment property sales in Atlantic Canada, making him and his team one of Atlantic Canada's top commercial real estate brokers. Please welcome Tom Gerard. Hey Tom, how are you?
Great, Jason. How are you doing?
I'm good. Thank you so much for coming on today.
Oh, you're welcome. My pleasure.
The reason I'm having you on is because actually for me, it's selfish for me. I don't know that much about commercial, and I've had clients in the past ask about commercial properties, and I don't really understand how that works as a whole. So
right.
I know how long you've been in the commercial industry for. So I thought I'll get Tom on just to share a bit of wisdom. So I guess my first question would be, how did you get into commercial real estate to begin with?
Well, interesting question. I mean, I was at Dalhousie University taking economics, and at the time I was in the military reserves. I was thinking different career options, whether it was military, maybe police, but I was also thinking business. And so when did I graduate? I'm thinking back, it was 1989. So I graduated from Dalhousie. And I guess that year I was just I was researching different business books. And one of the books, and you'll laugh when I tell you, at the time I had read was The Art of the Deal by Donald Trump.
Yeah.
So I laugh, and actually, anyhow, he, needless to say, he made the real estate business, development business, office buildings sound very interesting, and so it got my wheels turning. And then around the time that I read that book, Turner Drake and Partners, a commercial real estate evaluation and appraisal firm, was advertising for a commercial real estate trainee.
Okay.
And it was just perfect timing. And I decided to go apply. And I got the job.
You go on from there.
Yeah. And
okay.
So that was in the spring of 1989. And so I started at Turner Drake as a commercial real estate appraiser trainee.
No way. And it's gone on all the way since.
Yeah, and that's right. And then when I was there at Turner Drake, so I started taking the real estate appraisal courses for commercial, valuing commercial properties, and also what it's like to be an appraiser in terms of lifestyle and very deadline driven. And after about a year there, Mike Turner, the owner, president of Turner Drake, wanted to open up a leasing division.
Okay.
And he asked me, Tom, would you like to try leasing? And I was like, okay, sure. And so I had to get a real estate license. So I did that. I got my real estate license, and then next thing you know, I was a real estate salesman, and so my appraisal career was on hold, but that was fine. I was getting paid, and
you were doing fine.
I was doing fine, and basically next thing you know, I was dialing for dollars, calling up office tenants and warehouse tenants, asking them about what kind of how much space they occupied, trying to find out when their lease was expired, so. That's basically how I got into it. And once I got a taste of the leasing business and sales, I kind of never looked back. I said, you know what? I think I like this.
Amazing.
Yeah. Yeah.
So I guess what for the audience, what is a commercial property?
Well, that's an interesting question in terms of, it's comparing it to what is a residential property.
Yep.
Well, basically commercial, it's a very broad field. It's almost like saying you're in the computer business. Well, what does that mean exactly? Because it's so wide. And commercial is basic, for the most part, everything but residential. So when we talk commercial property, there's different asset classes. So we could take, office building, right?
Yep.
Office space. So, or shopping center, retail. And then we've got industrial, warehouse, manufacturing. So you got office, industrial, retail, and we can start adding to it, hotels,
Yeah.
That's another commercial property,
Yep.
right? And it's actually a business in itself within the commercial. And then of course, then we've got, well, you can get into commercial properties like, different categories of, automotive, car sales.
Love it.
You've got, so that in itself, there's actually REITs that specialize in owning and managing, car dealership type of properties. Self-storage is another area, right? So there's, within commercial, it's, and depends on the size of your market, but as a real estate agent, you can specialize, in any one asset class. Sorry, I haven't even touched apartment buildings.
Yeah.
So, and it depends on the size of your market. I tend to be more of a generalist in that, my career originally was more on the leasing of property, and then now it's more on the sales and working with investors. So, so I'm more in the office, industrial, and retail and multifamily space. But when you get into bigger markets, if you're in Toronto, you would either sell office buildings or lease office space.
Oh,
and pretty
okay.
much exclusively.
Yeah.
Right. Or shopping centers. If you sell shopping centers, I mean, that's all you're going to do. You would not be leasing
buildings or commercial space.
Right. It's typically you're on the sell side, and even with that, you might only work with buyers or only work with sellers. It's, in the larger markets, you tend to specialize. And actually what I've learned, and even Halifax, which I consider, it's known as a smaller market, but really I think specialization is key and important.
Yep.
And I believe that if you do specialize in one area, that business will come and you'll do better off.
Yeah, because you'll position yourself as an expert.
Yes.
And you can slowly understand the minutia of that one market. It's the same thing in residential when we say, you can specialize in the Fall River market, you can specialize in the South End market, the Dartmouth market. Like they're all, you can double down on a certain market and become that person, and you will win business because you are known in that territory.
That's right.
Okay.
Yeah.
So with commercial, I guess it's safe to say you guys sell spaces and businesses.
Actually, it's actually leasing or renting the commercial space, like office, retail, industrial, or it's selling the building that houses those components.
Oh, so you don't sell the business?
No, and again, that's another specialty. So business brokerage, right? And so actually, some agents do specialize in that, but that really, it's an area that the accountants tend to specialize. So in Halifax, a lot of the major accounting firms have CAs that specialize in valuing businesses and transacting in businesses. Okay. Right. Realtors might end up, say, restaurants. So in our office, Johnny Yang, he's got a background in owning, managing restaurants, and knows that, so a lot of his clients come to him that if they want to set up a restaurant, he consults with them from A to Z, the whole, from setting it up, to finding the space. He just knows the business inside and out. Yeah,
so he can appraise it properly.
Yes, that's right.
Okay.
But really, business valuation and selling businesses, that's
a different thing.
That's, in my opinion, it's
different can of worms.
Yeah, it's a different can of worms.
Okay. Yeah. So when it comes to you guys handle leases of commercial spaces and or do you guys sell commercial spaces as well?
We sell the property.
Okay.
Right. So if it's an office building, you could take any office building. We would list that building for sale, or we work with buyers or investors that would buy that office building. Yeah. Or if you're a tenant in that building, so if you're an accounting firm or a law firm and your lease is up and you needed advice on either renewing your lease, or you've outgrown the space, or it's a pandemic and guess what, we've got twice as much space and we want to downsize, we would help them basically review the market and identify other options and help them negotiate a new lease. Yeah.
Would you help them, let's say a business is coming up to their expiring lease and they have to negotiate a new lease and they want to negotiate new terms. Will you guys help out with that too as well?
We'll do. That's called tenant representation. Okay. And again, there are commercial brokers that specialize, and all they do is represent tenants. Okay. Right? And it could be within the office area or industrial or retail as well.
Yeah. Now, with one thing that gets mistaken with residential realtors like myself is the Ontario market, the BC market, they handle leases as well, like leases of rental space.
That's
but
right.
We're not licensed here to do that in Nova Scotia. Do you guys handle that as commercial agents? Do you guys lease spaces or no?
We do lease. So if a landlord owns a building and
Yeah.
needs help renting the commercial space, absolutely.
Okay.
That's what we do.
Okay.
It's called agency leasing. They would engage us.
Yep.
We'd sign a listing agreement, and it'd be our job to go out and find tenants and qualified tenants and lease negotiate the terms on behalf of the landlord. No, that's a big part of what we do.
I was wondering that because that's where the differentiation gets lost.
That's right.
When I was doing the real estate licensing course way back in 2016, I remember we had to do a corresponding course on appraising a commercial property.
Yes.
That is a much different thing than appraising or finding a residential value for a residential home. So how do you guys come to the value of a commercial space, just for example?
Yeah, interesting. So there's different approaches to value. So similar to the residential, there's comparable sales approach. So if I'm looking at, let's say in Burnside, take a typical warehouse that is an owner occupied, or that would, so let's take a 10,000 foot warehouse on an acre of land.
Yeah.
So how would I appraise it? If it's a vacant building, I would go out into the market and look at what is transacted in terms of similar size buildings, style of buildings, features. Comps. And then from there, you compare, and that's an indicator. So that's the comparable sales approach. And then you look at the cost approach, or reproduction cost new approach. So basically you take, the land's worth $7 or $10 a square foot. So you got an acre of land. So that's worth, at $10 a foot, $450. And now construction costs, a 10,000 foot warehouse, it's $125 a foot. And it's got leasehold improvements, 50% office, that's another $80 a square foot. So you kind of look at what is the replacement cost new, and then see, and that's a gauge of value, because if, people looking to buy a property, if they could always buy land and build and have the time, that's probably your ceiling of value.
Yeah.
Right?
Okay.
And then now where you start adding different, then you could value it from an income approach.
Okay.
Right. So that means, you would take that building. So let's stick with the same example of a warehouse, a 10,000 foot warehouse on an acre of land, freestand. What would be the market rent currently? Let's call it, because it's got extra land, let's be generous. Let's call it $10 net. Yeah. Right. So 10,000 times $10 net, there's $100,000 of net income. All right. So that's the potential rent. Net income means the tenant pays all the property taxes if it's a triple net lease, all the costs associated. So the return to the investor is $100,000 a year. So then, okay, now how do you value that income stream? Well, again, that's where you've got to understand what depends on the interest rate levels, borrowing costs, and so that does change. But you apply a cap rate. Yeah. So for simple math, and cap rates are much lower than this today, but call it 10%. So if the cap rate was 10%, 100,000 divided by 10%, there's $1 million value. Okay. Right. Cap rates are much lower now, more, and it depends. There's a lot of factors. So I don't know how much you want to go into on that, but.
Oh, I'm going to dive in.
All right. Yeah. So, yeah. And but the cap rate, it's a reflection of risk from the investment. So if you've got a AAA tenant, that signed, corporation that's signs a long-term lease, 10 years plus, and it's a new building and it's got great features, it would, and it's a triple net lease, and the owner, all he's got to do is, cash his rent check every month. It's a pretty low risk opportunity, investment, and the cap rates, tend to be quite low, particularly when you can go to the bank and borrow money at 3% and 4%, on commercials. So, you're tending to see cap rates, as low as on average 6% for that type of an asset, 6 or 7%. Okay. So, I'm
with you.
Yeah, right.
I'm with you. I get it.
Yeah,
I get it. Cap rates.
Yes.
The cap rates come up often in residential real estate when you're looking at investment properties. What is a cap rate? So what is the purpose of a cap rate?
Basically, a capitalization rate is a investment return rate, and it's basically a multiple of the income. So it's really a relationship between the income,
Yep.
the net income, and the value of a property.
Okay.
Right, and it's really market derived. So if you want to know how to find or determine a cap rate, you really, again, like a comparable sales approach, you'd analyze what income property is selling for.
Yep.
So if you go and find out that if you analyze 3 industrial investment property sales and you look at the income of the property and divide it by the price, and you say, okay, well, sale 1, traded at a cap rate of 6%, and number 2 was 6.5%, and number 3 was 7%, and compare that to your property and say, well, my property is most similar to sale 1 at a 6%.
Yeah.
That's a market derived
A cap rate.
Cap rate.
Yeah. Okay. So just studying how, it's similar to what we do in terms of the comps. You're looking around what's going on in the neighborhood, and you're saying, okay, I've got this box on this lot. This was what this box on this lot sold for.
That's right.
Similar finishes, similar sizes. Okay, I'm in that ballpark.
That's correct.
Okay.
That's correct.
What there was a lot of different ways to evaluate the value of a commercial property laid out. What style do you typically go with, or what method do you prefer when you are assessing or evaluating a property for value?
If it is an income property,
Yep.
it would be the income approach and
Yep.
very much the cap rate.
Okay.
Right. But there are a lot of levels and complications to that, because if, for example, you actually have to understand the market rent.
Yep.
So if you have a strong company or a strong covenant, that's great. Now the lease term. So if you've got a tenant and their leases, they got 2 years left on their lease, and there's a rollover risk. So if it's a single tenant building, if they move out, then you can be sitting on an empty building.
Yeah.
And it could take time to release
the building itself.
Right? So
Yep.
that's a reflection of risk, as well as the rental rate they're paying. If they're paying a high rent, which, that's a high rent they're paying, that's going to be a difficult income to
achieve again
on renewal. That's another risk factor.
Yeah.
Right. So those are all details that go into the cap rate, and you'll be, as an investor, what will help you through that process is when you go for financing, your banker is going to ask you those questions, and because he's lending the money on the property.
Yep.
And he's usually got more skin in the game than the borrower does.
Yeah.
And he's more concerned about that typically than oftentimes than the investor.
Yeah.
So he's getting it appraised, and he's asking these questions and wants to understand
what's going
the
on.
Probability.
Yeah.
Right?
Yeah. Well, yeah, because banks, as I try to educate with my buyers, banks are there to protect their skin.
That's right.
Right? They're happy to lend out money, but as long as that's why we have the mortgage insurance premium on anything below 20% down payment. It's because banks don't want to give out $200,000, $250,000, $300,000, $400,000 to someone without the insurance below 20%, because they want to make sure that their money loaned out is safe.
That's right.
Anything above 20%, they were going to get it appraised. They're going to get a proper valuation, because they want to make sure they're loaning the appropriate amount of money, because if you foreclose and they have to take possession back, they want to make sure their investment at least returns what they paid. Right.
That's right.
That's how banks work. So the one thing I'm interested in is that in the last year, the Halifax residential real estate market has taken off like a rocket.
That's right.
There's lots of comments. Everyone, everyone's paying, X amount of dollars over asking, the bidding wars. We've all heard the stories. How has the Halifax commercial real estate market been in the last year with COVID? And what's the impact been for COVID on the market?
That's a very good question. It's interesting. At the beginning of the pandemic of COVID, there was a lot of probably belief that there's going to be blood in the streets, and what's been very interesting, it's the opposite has happened, certainly on the residential side with housing, but commercials there's been a different story.
Yeah.
Depending on the asset class. So clearly hotels, when travel's down, restaurants and bars shut, and you can't come to Halifax to see a concert or anything. That
Yep.
has not been good for the hotel industry. So So certainly that's been an example of a commercial asset class that's been hit hard.
Airport industry as well.
Airport industry as well,
Yep.
right? And then you could take now office space. That's another interesting one. Depends on where it's located, but certainly downtown office buildings that, like Purdy's Wharf in Halifax, but it's in bigger cities when you got 30, 40, 50 stories. When you got to wait 20 minutes for an elevator, one person at a time, people aren't even going to work, right?
Yeah.
So a lot of office spaces have been sitting empty, still are since COVID.
Yeah.
Right. And so in terms of the supply and demand, it's been more challenging for landlords to lease office space. So office tenants whose leases are coming up for renewal, they're actually on the fence. So a lot of them are just renewing short term, not committing to a long-term lease. And if they were expanding before the pandemic, they're tightening up, or they're just waiting. So a lot of people are treading water, renewing short term, and some people are actually downsizing, and just not renewing. It depends on the size of their operation. So that's office space. Of course, that has an impact on value. And where we're seeing that as well. So let's take office space to go to we were just talking about financing, about going to the bank. You want to borrow money to buy an office building. Well, the banks are looking very closely at who these tenants are because for you to pay your mortgage, you got to collect your rent. Right. And it's affected and impacted by it.
Yeah. Are you guys seeing more supply on the market or less?
Well, in terms of office space, there's limited development happening of new office buildings, and that's been like that in Halifax. There's been slow development, in the suburban. Armour Group has been developing, and typically, for the most part, when they have a tenant in tow, they've been building for a tenant they've had in hand and building a building, not building as much on spec. But where we're seeing the increase in supply is sublet space. So downtown, there's a fair amount. So right now, it depends on which survey you listen to, but there'd be, say, in all of Halifax, 11 million square feet of office space. The vacancy is around 14% in that range.
Oh, is that high?
But it's actually, for office space, it has been, double digits for a long time.
Okay, so it's not like your supply and the vacancy rate is not what we've seen in the Halifax residential market.
Correct.
Okay, so you guys has it risen since So
definitely it's risen, but the other impact on the vacancy rate is now we have a number of sublets. So companies so they have a lease commitment. They might have 3 or 5 years left on their lease. They're not going to the office. They don't need it. So they're marketing their properties for lease or for sublease.
Yeah.
Right?
Okay.
So that's another. And again, I'm seeing some surveys around 2%. Of inventory is available now for sublet.
Okay. When you have a client, the lease expiry is coming up, and they want to negotiate a short-term lease. What's a short-term in commercial? Is it 1 year, 2 year, or is it 5 rather than like a 10-year commitment?
Usually short-term is anything under 3 years. Most landlords are looking for a 5 or 10-year lease commitment. Okay. And a lot of what's driving that too on the tenant side is leasehold improvements. The costs now are $80 to $100 a square foot. Yep. And if you're looking at an office rent, if it's a Class A office rent downtown Halifax, it's 20 net, and your CAM and taxes are another 15 to 18. Well, if leasehold improvements are now pushing $100 a square foot, well, that's without interest. That's $10 a square foot a year. So on a 10-year lease, you're amortizing that over 10 years. So you can't go in on a short-term lease and spend $100 a square foot on leaseholds.
No, I understand. Right? I understand the math.
Yeah. So on the sublets, that's usually the leaseholds are already built out. Yeah. So it usually involves someone just giving them the keys and they're taking it over, moving in furniture at all.
Yeah. Okay.
And those are shorter term. So I guess your question is, what is generally in commercial considered a short-term lease? Anything from month to month to 2 to 3 years.
Yeah.
Right?
I get it.
Yeah.
Okay. How are prices in commercial spaces right now? Like, just in a sense of, like, are they climbing or are they falling just because of the amount of supply you guys have?
So I guess, again, from the tenant side,
Yeah.
from the tenant leasing side, as office tenants, they're generally falling.
Yeah.
Now, again, it depends on the scenario.
Yeah.
But I would say if you went downtown and looking at office space, because of the amount of sublet options, you're in a good position to negotiate a lease.
Yeah.
Right? However, if you went to, say, a Purdy's Wharf to negotiate a 10-year lease and they're an institutional landlord, they're looking long term.
Yep.
They're not,
Yep.
they're not.
They're not going anywhere. It's Purdy's Wharf.
Yeah,
That's a staple.
It's a stable asset, right?
Yeah.
And so they are maintaining
what they have been
rates.
maintaining. Yes, they're not going to give you a discount just because there's a bunch of other suppliers available.
That's
because
right.
Purdy's Wharf is a stable in the community. It's not going anywhere.
That's correct.
If anything, the parking will keep them alive alone.
Because
Because I parked at Purdy's before, and yeah.
That's right.
When it comes to commercial, the thing I'm trying to understand it as well, because I have clients who ask about commercial. You guys do multi-units as well.
That's right.
So what is your, at what point does a multi-unit no longer be residential and it's now commercial? Like how many units?
It's usually 6 or above. It comes down to the financing.
Yeah.
But for multi-residential, as soon as you go to the bank to borrow on an apartment building, if it's 6 units or above, it gets into a different loan class.
Okay.
Right. And so typically, yeah, my properties or my area is typically 12 units and up.
Okay.
But sometimes I get under 12 units. It depends on where it is, So we just closed an 8 unit, had 1 commercial on the ground floor and 7 units. It was in Fairview on Dutch Village Road. So recently.
Okay.
And yeah, and so another transaction I'm dealing in or dealt with in multifamily, but it's also, is it multifamily or is it development site? Because it was, 4 sets of over and under flats.
Okay.
Contiguous.
So
right?
8 units.
8
four
units,
four duplexes.
Four separate PIDs.
Yeah.
Right?
Oh, interesting.
In a row. So the buyer is really buying it for the underlying land value.
Yeah. Right. Yes. Because you're not, if you're going to pay that much for 4 PIDs and 4 lots and 4 over duplexes, truth be told, I can't imagine the return on investment on the rents being that phenomenal.
No, it nowhere near.
I can't.
Makes
Yeah.
sense.
If you're looking for a rental, especially in Halifax right now, renting it, purchasing a income property, even in the residential sector, I look at a lot of clients and I'm like, I don't know if you want to and buy a triplex in Halifax right now. I just saw one listed at $800,000. And there's no, and they're advertising the potential leases as $1,700 a month, and that doesn't cash flow. That's so right. You're immediately buying a negative asset.
That's right.
Which I don't understand if you're investing why you would want a negative accruing asset, because that's only more debt, more you have to pay the. It's a thing.
Right.
So when you get a multi-unit 6 and above, you handle. What do you look for when you're pricing it? Is it the same thing as us, as we're going to look at the comps, or is it you're going to look at the rents, the cap rates to see what kind of threshold that looks at?
That's right. Well, as we're into a low cap rate environment, it's really looking for upside.
Okay.
So a lot of the property trades we're seeing, they don't make a lot of sense on the price going in. So people are saying, well, why do you pay that much? And it's usually because when you scratch below the surface, you say, well, the owner maybe didn't have a mortgage on it for 20, 30 years and kept his rents low.
Okay.
And so the buyer felt that they can go in and renovate and get the rents up substantially. So, so if you look at the cap rate, it might look on the surface that he paid a very low cap rate or a very high price. But the buyer really isn't planning to go in and renovate the units, get the rents up.
Yeah.
And that's how he's going to realize his value and justify the price he paid.
Yeah.
Right?
Yeah, no, I understand that. It's called BRRRR. If you want to refinance, take the money out of the
That's
property.
right.
You can BRRRR your money. You can get your money out and go put it somewhere else. We talk about that a lot on the podcast. That's been in the headlines recently in Halifax just because of the renovictions that's
right.
happening. What are your thoughts on the implementation put on a 2% rent increase until February 2022 for real estate investors?
Yeah, it's personally, I prefer that I'm not a believer of rent control.
Yep.
And I believe that landlords, they get a bad rap, and landlords will look after their tenants, and they're good tenants.
Yep.
And want to keep good tenants. And I mean, of course, you could find, there's always some bad apples or instances.
Always. Yeah.
But, and that happens on the tenant side. But I think landlords that have good tenants want to keep them and will work with their tenants. And at the same time, we do have, it is supply and demand. It is a business. Landlords want to grow their portfolios, and they're doing that either organically by buying land or buying existing buildings, old buildings, tearing them down and building.
Redeveloping.
And with the high costs, they're forced to charge higher rent. So that's...
Yeah. You're as a developer or a real estate investor, it just doesn't make any sense in the world to buy an asset that's going to lose you money. That's how you lose your house, your home, your like that. It doesn't make any sense. So when you have to go in and purchase an old building and you're going to pay a premium if you're anywhere in HRM, right now, given the market what it is, you have to do something to bring up the threshold.
That's right.
The only thing I don't agree with the 2% cap is I just think it's going to stifle investment.
That's correct.
And and like the way Halifax is, rents are increasing at such a rapid rate that even the lesser taken care of units are appreciating in rent, which is a shame because they're not kept up the way that they should be, because
That's right.
Other landlords or other developers have gone in, invested the capital, invested the money, taken the time to bring up a good unit at a good rental rate.
That's right.
And it's like a net problem.
That's right. And the other thing, it doesn't reflect. So if a landlord has rents that are already at market, 2% isn't so bad, I guess. Let's say he's getting $1,000 a month, and that's really the market rent.
Yeah.
So for him, a 2% increase, okay, maybe he could get 4 or 5, but it's not the end of the world to only get 2%.
Yeah.
But you could take that same style of building in the same area, and again, we've got the example of the landlord who hasn't raised his rent forever, and all his tenants are
25 years, 30,
and the rents are $200 or $300 below market.
Yeah.
Right now he's stuck at, if he wants to raise his rent
to what market value.
That's right. Or if he wants to sell his building and the new owner wants to renovate, bring up the quality, of the rental stock or in that property. So that's where it's not fair, and it doesn't, that 2%, it's applied across the board, but every scenario is different.
Yes.
Right. And I know landlords, you can take areas, won't name streets in particular, but where, say, rents were $500 or $600 for the longest time. I know landlords that I've sold buildings to, and then they've actually gone and they have a senior citizen in the building that was paying $500 or $600 rent for 10 or 15 years.
Yep.
That's their home. They don't want to move. But he's actually gone and renovated that unit to a much higher standard and putting in IKEA kitchens, and this is the small units, and then showed them that unit and basically said, would you like to have that? And they said, yeah. And he said, well, the rent's not going to be, if I did that, your rent's going to be $900. And they said, well, they don't care.
Yeah, they can't afford it.
They can afford it, Now, obviously, it's different if someone just can't afford, and those, and so oftentimes, and again, usually a lot of landlords, if they don't have to renovate, they'll keep them there in that unit, in the original. Some people are happy with that, and they won't, but they do respect that person's, it's been their home for many years and generally want to keep them there. And that's my experience with a lot of landlords.
I found that the backlash against developers and landlords has been harsh because like I said, I know a few who take pride in their tenants, take pride in their ownership, and the people I feel bad for the people that have been rent evicted because of or improvements being made on a dwelling that was purchased by a developer who needs to bring up the cost so he doesn't go bankrupt.
That's right.
I understand that aspect of it, but I also understand the fact that a lot of times new developers are willing to work with the old tenants, and but that doesn't get highlighted enough in a sense that a developer or a landlord will walk in and we'll talk about an older unit, not in great condition. They'll bring it up so it's a bearable standard, but they're not going to bring in the new IKEA kitchen. They're not going to put in the new cabinets, new bathroom. They're not going to do that because they're going to ask the tenant. I've heard great stories of people asking the tenants, are you okay with this threshold? And the tenant will say, no, I can't afford that. And they'll say, okay, well, we'll make it livable because it was a slum beforehand. Mm-hmm. We'll fix the leak in the faucet. We'll bring up what we got to do, and we'll renovate everything else. And when it's your time to leave, we'll just simply come in and we'll do the job. And that's what I've seen. How have your investors reacted to this 2% cap that you're working with right now, if you're working with any?
Yeah. No, I think they find it frustrating because they feel that when the government gets involved, it's the landlord is treated as the bad guy in some of the optics.
Yep.
But if you go buy a building, and let's say you pay $2 million for the building,
yep,
and the assessment is currently $1 million. Well, the municipality doesn't care about the pandemic. Assessed values are determined by Property Valuation Service Corporation, a third party, and they just look at, a transaction at $2 million. They're going to increase the assessment from $1 million, maybe not to $2 million, but it could
1.7,
1.8.
Yeah.
And all of a sudden the landlord gets a tax increase of 50% or 75%. Pandemic or not, he's got to pay that.
Yep.
Right. So
I understand.
Right. The landlord has to call in a plumber, difficult even during the middle of the pandemic, but plumbers are in high demand.
Yep.
Right. And so they're lucky to even get a lot of them. Whoever comes along, you'll do a grade, and then they get a bill for what used to be, maybe a $50 bill to unplug the toilet. He could get a $300 bill, but no one's telling the plumber that it's a pandemic, you can't charge $300 or whatever they charge.
Yep.
Right. So there's no controls on
the cost of all the other facets that go into it.
Yes.
So.
Landlords do want to improve the properties, but there's this economic reality. So it's almost taking away the ability for the landlord to actually invest.
Yes.
So they're just going to put on things whole. Well, guess what? I'm not going to do anything as far as renovating, improving. I'm not putting new carpets in my hallway. I'm not replacing windows right now. I'm just going to kick the can down the road.
Yeah,
because I can't increase rents.
Yeah, and to get a return because of the increase. Also, even it's even the entry door of getting into investment properties right now. Because I'll take the example of the $800,000 listing I just saw. If you were to purchase that for $800,000, let's just say you get market value. What the market dictates that value is $800K. $800,000, your mortgage probably going to be between around $5,000 a month, I'd say. I'm probably wrong. Ask a mortgage broker. I'm a realtor, guys. Mm-hmm. Don't hold me to this number. I picked it out of thin air. Let's just say $5,000 a month. If the rents in the units are $1,700 a piece, you're already negative.
Right.
And let's say that triplex that is on for sale right now hasn't had a sale in 10 years.
Right.
Property value in it has skyrocketed because you're on the Halifax Peninsula. So you're going to get a tax assessment, as you said. So right from the get-go, you have a negative accruing asset, $1,700 a piece. You're going to get hit with the property taxes. You're going to get hit with the other costs. If I'm a potential developer or a real estate investor in Halifax, I'm thinking I'm gonna hold off on that 2% to pass and see what they do with it. Which my only thing is that without developers, without real estate investors going into a market, you don't get the updating of neighborhoods.
Right.
You don't without people going forward and putting their capital into those neighborhoods to bring up, if one house gets purchased and a flipper goes in and resells it at a great value and they build a great magnificent home, that's going to bring up the value of everything else.
That's right.
Because people now understand, I can do renovations and bring up the house. The house next door can say that, and you can accrue that gain in the market because you've done that work. That only invites first-time single families. That only invites and builds greater communities, and businesses follow people.
That's right.
That brings in restaurants, that brings in barbershops, that brings in so much outside investment. And right now, the way I look at the residential market is we need investors.
That's correct.
We need people to buy into Halifax to develop the areas that have been neglected. You look at the example being Spryfield right now. Spryfield's had a stigma against it for so long. It's almost like people are so scared to touch it. Like when I work with a buyer who's my age and I say, listen, Spryfield's a great place to be in right now. And they look at me like, you get the face. I'm not going to Spryfield. And I'm like, no, you don't understand. A hospital, like the new high school is being built. They just put in 1,200 new homes in Governors Brook. They're still developing Governors Brook. And now single families are moving in and investors are moving into Spryfield, and they're taking down these awful worn down bungalows that were never maintained, and they're turning it into a glam bungalow that is a home for single families. But without the investors going in first and seeing the potential of that value, you're only going to stifle that. And the thing for me is that if you stifle investors, you're going to stifle growth. And right now we need growth on an unprecedented scale because of our immigration, because of our supply, because of our demand. The only way to get out of this is investment. And if we cash strap them, I'm thinking like house prices are only going to go up. If we don't get
we have a housing crisis.
Yeah.
So you let the market, the free market forces, supply will come.
Yeah.
I mean,
yeah.
Let developers
do
buy
what they
land
do
and build.
Yeah.
And investors renovate, buy property, and things will creep up. Supply will find a balance.
It will find a balance.
The housing market will work out. Yeah.
I will say, like, rents are absurd. We've seen that across the board. The average rental is, I hope they find a balance too, but the only way for rentals to find a balance is more supply.
That's great.
Because it's the same thing as houses. If this other rent down the road is collecting $2,000 and I'm at $1,000, I'm looking at that and we're the same size and I have to just update a kitchen, that's a $10,000 fix, that's a $10,000 investment. Okay, but I can get $1,800, $1,900, and there's nothing else available. Well, if someone wants to live in this neighborhood, they're gonna have to pay this premium. If you look on the flip side and that $2,000 renter has competition of 10 other units all at $1,200, $1,300, $1,400, they're never gonna get rented.
That's right.
Because people are always gonna go to the best product. Buyers, and we'll throw renters in that term right now for this analogy, but buyers are the most educated people they've ever been in real estate ever. I know my buyers are more educated in the market when they look at specific neighborhoods than I am, because they're in that market. They're looking at that market. They're looking at all the sales stats. And I've got 4 or 5 buyers right now. I'm in Fall River, Porters Lake. I'm in Sambro. I'm in Brookside. I can't look at, I'm looking at things as I can, but I'm not on as top as someone who only is focused on North End Halifax. So we need that supply, and I look at the 2% as just, I thought it was to appease public demand. I was disappointed that the city didn't at least correlate or coalesce with real estate investors on a larger scale, just because there is a solution in there. I don't know what it is. I'm not a heavy investor, but I know there's something in there that can help both parties, because you have to treat the public well. The public has to have access to land and has to have access to the peninsula, because the peninsula has gotten so overpriced. There's something in there. I don't know what it is. My rant's over. We haven't touched on this topic on the podcast yet, so it's been in the back of my mind for It's nice to hear your take though, just because it's nice to know that investors are apprehensive now about getting into the peninsula. But that's also a cool thing, because outside bungalows now get all the interest.
That's right.
Are you seeing a lot of investment in the outer rims of the city now?
Well, we're seeing it all over. I think what you'll find, the peninsula, it trumps everywhere else. And I think just because long term, if you buy a piece of real estate on the peninsula, it will appreciate faster than any other area.
Yeah.
And I think that's consistent with probably any city anywhere, right?
Yeah.
It's going to go up faster. So if you're a long-term investor, buying on the peninsula versus other areas, you will do better off. That said, you might get better returns, as far as cash flow. If you're looking for cash flow in your investment, you'd be better off maybe to buy a set of flats in out whether Sackville or Cole Harbour or somewhere, or Spryfield versus South End.
Yes.
Right. So it depends on your view, but in general, I believe, when I look at replacement costs, inflation, so real estate in general, I believe we're heading into inflationary times.
Yep.
You know, ours continue. We've had inflation, but
We're pretty inflated now.
It's going to go. So having money in real estate or assets is a good thing.
Yeah.
The interest rates, I believe, will continue to stay low, so real estate will continue in Halifax, in my opinion, to go up in value in everywhere, but just some areas will go up faster.
Well, I always tell all my buyers right now, if you get away from the peninsula, you're gonna not pay a premium. And the further you get away, the further you are from the premium.
Right.
Because everyone wants to be on the peninsula.
Yeah.
It's just the demand, the draw of the downtown area, the restaurants, the maybe a lot of people work in the downtown core. Everyone works from home now, so I find that surprising. But the further you get away from the premium, the more affordable things are going to be.
Right.
It's just the peninsula now for me with my clients. I'm showing people homes in the peninsula, and they're like, I'm paying $500,000 for this, and I'm like, go to Fairview, go to Armdale, go to Spryfield, go to downtown Dartmouth, go to Eastern Passage, and go to Lower Sackville, go to Hammonds Plains, Bedford. I don't care. Take that $500,000 and look at another market, and I promise you're going to get a much better home.
That's right.
And you're not going to compete, which is outrageous. There's someone's going to compete for a $500,000 two-story home that is in awful condition on the peninsula, but the location. But as you said, that's your greatest appreciating asset, and it will only go up as more and more developers come into the peninsula.
That's right.
Which is happening. It's an interesting time to be in the market.
No, absolutely.
Here's a question, and I've been trying to understand this for myself. If someone wants to buy a commercial space, right, or lease a commercial space, when you get a residential family home, so like a 2-bedroom thing upstairs with commercial downstairs, how is that value driven? Like because you have a commercial residential asset in the same structure, how is that value driven? I know it's a trough. I know there's a lot of things in that.
Well, okay. Well, you break it down. I mean, so let's say if I was looking at a 2-story building that had ground floor retail or office space on a street like Quinpool Road, and then on the second floor it had 2 or 4 apartments. Yeah. You know, from a value, I would value the commercial. Yeah. As I would anything else, and the cap rate, how I'd cap that income may be different than how I would value and cap the income on the residential. Okay. So the second floor residential apartments, that would be a lower cap typically than the commercial. So if the going cap rate in the south end or on Quinpool Road for residential might be, well, it's no more than 5. It could be lower than 5 now, 4.5 or 4 even. Yeah. You know, so you put a lower cap on the residential, and then again the commercial depends on what the market's number doing. Of factors in the market, but so you'd apply a cap rate to that. Okay. So I guess from valuing, so I break it down. Yeah. And then a whole another layer is the underlying land value. If with the new center plan, if my property on Quinpool is in an area where the maximum density or let's say floor area ratio might be 2 or 3, or maximum height could be, now it's in meters, but it could be 10 and 12 meters or 20 meters versus if I'm in an area of Quinpool where I can do 20 or 30 meters or higher, and the higher FAR. So that means you may only be a small property you're looking at or buying or owning, but you could be part of a major land assembly. So you got to really understand, what you're purchasing, what the zoning is, and what is the environment. Because if you're in the middle of a block that could be redeveloped, and a major 20-story building or 30-story building could be built, and it's got a high FAR, high floor area ratio, that has significant future impact on value. Oh, so do you guys consider this the center plan? And absolutely. You guys have to consider what the city's planning on doing in the long term. Okay, I didn't realize you guys followed that so closely for your own values. So when you guys are looking at or assessing a commercial space, you're also assessing what the future will be
based on
Absolutely.
what the city center is doing. Because if you're buying like a little mom and pop barber shop with, two bedroom, 2 bathroom condo or unit above, you might realize, oh, well, next door they're going to put in 20 units.
That's right.
Full of commercial spaces. Will that positively affect value, or that negatively affect value?
Well, any renovation or rejuvenation in an area is
Gonna bring it up.
It's going to bring it up.
Okay.
Right. I mean, you can be almost, if there is a developer doing a land assembly, if he doesn't need you, he's built around you, he could almost lock you out. And, I've had situations where the developer wasn't able to buy the property, and once he's got approval for his development, he doesn't need it anymore, and it's no good to him because his development agreement is done with the city, and and the project's being built. It's already
approved.
formed, and he doesn't need the property.
Interesting.
Yeah, so owners can hold out and get greedy too. So they have to.
You see that happening.
That happens.
You see that happening in the fact that like sometimes if. This is why you can't let the cat out of the bag. But if you have a developer developing land and there's one last home that needs to be sold, that last person can hold out for the big bucks because they know they have leverage.
That's right.
And I could bring up, I know an example right now off the top of my head in South End Halifax.
That's
where
right.
we know that there's a large lots of land for sale. You've had your name on it. I know a few other big name realtors have had their name on it. And I had wondered why it hadn't sold it's been on the market for years. It's the end of Beaumont in South End.
Oh, well, actually, we actually sold that.
Did you?
Yeah.
Oh, I didn't know. Oh, I didn't know you sold it. Oh, well, that's good to know.
That was, so now they're doing single family lots. So we sold it as one parcel.
Okay, you guys did sell it.
Yeah.
Okay, I didn't know you guys had sold it. That was my thing.
We did.
Because it's back on the market again.
Oh, well, as one piece or maybe as individual lots?
I think individual lots. I think individual lots.
So we had marketed and sold it as one
large okay.
Piece. So it did sell to a developer.
Okay.
That was at least 3 years ago now.
I watched it for years, but there's still a sign on it.
Yeah.
Because my parents live down there.
Okay.
So I'm down visiting often enough that I drive by it and I'm like, how is this thing still? How is there still a sign on this lot? Because I'm looking at South End lots,
right?
And you're like, and then you see that, little white house in front, and I'm almost like, is he the one?
Right.
Like, is he? Right. What are we doing here? and I know that like the grammar school, my parents live in the same area as the grammar school, and I know that the grammar school is consuming houses on Atlantic to develop the school size of the Tower Road location.
Okay.
And it's funny because like my grandmother's house is the last one in the line, is the first one in the line where they don't need it. So everyone else down is in negotiations, or like I know grandma's trying to purchase them. And I've talked to a few of the homeowners and they've mentioned that, oh yeah, well, we're going to ask a number. And I'm like, what's the number? And they tell me the number and I'm like, okay, you got leverage. I understand.
That's right.
But that's also the purpose. That's also the thing with developing, is if you're going to put in big money somewhere, that is the risk of doing business.
That's right.
In a sense that you can have that thing you can have that someone who has land, someone who has air being the building or the condo, that they're entitled to ask, and you're most likely going to pay out. But it'll be like the way, luckily with business and investing, typically works out.
Right.
With I guess before I get out here, I'm gonna end with this. What do you've already said that prices will rise in the future. How do you see the commercial space handling post-COVID? Do you think, like in terms of the general market, do you think we're going to see a influx of people going back into commercial spaces, or maybe an influx of people working from home that has a negative impact on that market? And I know we can't predict things, but just like, in your experience, you've been in the industry for 30 years.
Yeah. So my feeling is that, the working from home has been an interesting experiment, and I think people have learned, I guess they can be productive at home. And at the same time, I think that novelty is worn thin. And I think for business owners that are serious about growing their company, I think you can keep your company going. Everyone's trained. So, if you're an accounting firm or a law firm, you've got seasoned lawyers, so they can work from home and be fully functioning and be productive. However, if they're trying to bring on, say, graduate lawyers, that's where I think that the issue where the cracks.
The entry to new positions.
And new positions, a lot of training people, right? Yep. They need to be around in the environment. And,
it's funny you bring that up because I just think of the office,
right?
The Keller Williams office that we have in Bedford, because it just opened like last week.
Right.
And when you bring up training, I just remember when I was new, I relied heavily on training.
Right.
And I haven't been to the office since March 2020. So I like entry level positions. I get where you're going in that they have to have these commercial spaces to have at least seasoned veterans be able to shed knowledge, share wisdom with the industries and how they work. So do you think, so your idea is that your thinking is that the commercial spaces will exist, but maybe just in a smaller capacity?
Oh, well, I think, in the short term, people do generally right size. I mean, office space is expensive. You pay per square foot, and business owner, they're always, look at the bottom line expenses. And so they try and minimize their expenses. So if you have a surplus, if you think you don't need office space and your lease is coming up, the tendency is to downsize if you can.
Yeah.
But I guess when I'm looking at the commercial sector, I believe that, that we're going to COVID, this will get behind us, or even if it's here, we'll learn to deal with it, whether it's, through getting vaccinations or what have you, but we'll just learn to manage through it. And I believe people will be getting back to work in an office versus from their home.
Yeah.
We might see, people, there will be maybe some more flexibility, work from home flexibility, and because there's trust. Employers understand that their employees can be productive, so they're okay with their employees staying at home, or working from home 2 days a week.
Yeah.
Maybe, and they know they've got the setup, right?
Yeah.
Other employees say, no, I got young kids, or dogs and cats and too many distractions. I'm not productive at home. I got to be. I think some of that's going on. I think there's people that are actually working in a business center because they can't work downtown and their office are shut out, but they're stuck and they don't have a good, productive home work environment.
Yeah.
Right?
No, I get it.
Yeah. So, but I believe commercial will come back and be strong. Be strong and
great. Tom, thank you so much for your time. Thanks for coming on today. It's been a pleasure.
Well, thank you, Jason.
No problem.
I really enjoyed myself today. Looking good.
We'll get you on soon again. Thanks, Tom.
All right. Thank you.
Bye. If you'd like to get in touch with Tom, you can reach him at 902-830-1318 or Tom Gerard at kwcommercial.com. And if you'd like to get in touch with me, you can reach me at 902-220-7357 or jason.paul@kw.com. Thanks again. Bye.